I think their primary goal, and certainly boards do serve at the whim of your shareholders, so they do want this to be about creating sustainable shareholder value. And lastly, and something we encourage, is that this process be or easily be integrated into the board agenda so it becomes part of the routine dialogue between management and the board. So let's go ahead and talk about what we're going to be covering this morning. Very quickly, we'll talk about setting up the process, and the first thing is setting up your criteria. The second point is comparison points, which is basically what do you benchmark or what peers do you use to facilitate this dialogue. Developing your scorecard, setting specific goals within the context of that scorecard, adopting a process to use the scorecard, and then lastly, how do you integrate all this into your operating environment. From that first step, we talk about the criteria. And the criteria we'll be talking are criteria that we are comfortable with and certainly are confident that represent best practices, but certainly not limited to these. But the first step in selecting your criteria, you want to identify those key indicators, be they measures or metrics, that you believe drive value. And certainly, with that, you want to kind of take a look at what the industry standards are and integrate those. And then lastly, you certainly want to select indicators that are easily accessible, information you can get your hands on without too much trouble. The 8 criteria or indicators that we generally recommend are growth, return on average assets, return on equity, net interest margin, efficiency ratio, asset quality, relationship management, relationship-based low-cost deposits, and non-interest income. Because remember, we're talking about value, and the other piece, once you select that criteria, is defining how you measure value, or what is it you're trying to measure. And in most bank cases, it's either trying to drive to the highest trading value, trying to create a sustainable and growing dividend stream, creating maximum liquidity in the bank stock, or in some cases, perhaps even evaluating creating value for the greatest exit value. Number 2 is identifying those comparison points, both in terms of benchmarking and peers. So the first step in terms of doing so is select your peer group. And this is a group you want to benchmark your performance against. And you certainly want to select peers that have common characteristics. And those characteristics may be size, age of the bank, where the bank's located, their business model. Do they operate in a consistent or a similar fashion to you? And perhaps charter. Are they a sub-S with a particular focus, or a C Corp that trades? These factors kind of weigh in as to how you select your peers. Now, in this case, we always recommend that in some respect you want to include some peers that have a market reputation, performance, or value creation, thereby kind of implying a raising of the bar. From that point, you've selected your criteria, you've selected your board. So now it's creating that scorecard or the formula so that you can create a vehicle to communicate between you and the board. So what you're seeing here is an example of a scorecard we use, but you can see 8 columns there that represent asset growth, ROA, ROE, net interest margin, efficiency ratio, non-performing assets, non-interest-bearing deposits, and net interest margin. And then there's an aggregate score. So what we're looking for is a well-defined structure which should allow you to review the key findings in a single page. In this case, you can force rank your performance by each one of those performance categories or indices, and then create an aggregate score that you can kind of force rank your bank in. In this case, the sample bank among its peers based on these performance criteria is rated number 3. So you kind of have a top to bottom structure in terms of how you're assessing performance. Once you've kind of got that methodology or that formula in place, and we can talk more about formulas, or we certainly encourage you to contact us to do so. But the next step is once you've aggregated your score, is kind of take a look at what's your basis. How do you want to set your target? Now, a lot of banks we work with set a simple goal of the bank's goal is to remain in the top quartile of its peer group. So in this case, the sample bank is ranked number 3. And great question. I'll just answer this on the fly. One of the questions that just came in is what's a good number for peer groups? We think probably ideally between 12 and 15. Some banks go as few as maybe 6, 7, or 8, but definitely around a 15 number is a good number. Because again, if you're looking at the top quartile, that would basically say you're in the top 3 or 4 banks of your peer group. And just a closing comment, Oh, another question. Do you recommend local peers or peers located in other states or similar market areas? A great question. In terms of selecting those peers, they may be in your local market depending where you are, but when you take a look at your business model, look within your state, maybe even outside of your state, for banks that may actually operate in a similar fashion that you do, because you really kind of want an apples-to-apples comparison. But just in terms of these ranking goals, just a closing thought, as an example here at number 3, this bank is clearly in the top quartile, and so between management and the board, they're saying, okay, we may be, number 12 in asset growth, but we're higher in other key factors, but in aggregate, we want to make sure our bank stays in the top quartile. Now, there's other ways you can do this. That just happens to be one of the best practice methodologies. So now you've got your criteria selected, you got your peers, you got your scorecard, you have your ranking. So what's the process look like? The process we recommend is pretty straightforward, and that's establishing a dialogue around kind of identifying strengths and weaknesses within the peer group, not only in terms of what you do well, but over what period of time. Is it sustainable? So in doing so, in this case, we're giving you an example of strengths and weaknesses. I do want to comment as well as part of your process is to adopt a routine cycle. And again, we recommend, data is usually available 30 days after the end of the quarter, so that at least once a quarter, somewhere on your board agenda should be this dialogue. And I would also like to mention, with May coming up, this will be the first quarter of reported data for 2011. So if you like this process, I would certainly encourage you to use May as a month to kick this off at your next board meeting. But anyway, just taking a look at the example in front of us, in the left is the peer scorecard, and our sample bank is rated number 3 in net interest margin, or I'm sorry, number 2. And then the graph you see to the right shows how they're performing, the blue bar, versus that peer group in red. And actually, we also include the regulatory peer group in green. So right off the bat, this is something that the bank can say, gosh, we do well at it. We're number 2 in our peer group. And the question might be, is this something that we can sustain or leverage because it's a key strength? And you can see from this snapshot, we're still staying to kind of a one-page format. Conversely, if you're going to leverage strengths, you also want to mitigate or improve weaknesses. So this example shows the same peer bank, rated number 3, that happened to be number 10 in ranking in non-interest income. Again, you can see their blue bars are well below the red and the green. In this case, they're number 10. This is where best practices or not reinventing the wheel comes in. If you want to do better in non-interest income because it's going to drive value for your bank, take a look at those other peer groups, identify maybe the 1, 2, or 3 bank, take a look if they've been doing this well over time, and do a little homework. It doesn't hurt to painlessly swipe from others that are doing something well. It doesn't always have to be invented here to get there. So in terms of your process, look for frequency, at least quarterly, talk about strengths and weaknesses, and then start looking at how does this affect your strategy or modifying business practices to continue that journey to creating value. And then lastly is, how do you integrate this into operating environment? And it's kind of important to mention that every bank, when you start adopting a new process, you need to get comfortable with it. You need to take a little time. Make sure that you have faith in what you're looking at, that it makes sense, that it supports what you're trying to do. But once that comfort is established, think about the power of this system in terms of creating value. If, for example, you set being in the top quartile as a primary goal for your bank, you can start looking at areas of the bank that can be tied or linked to that goal. For example, compensation plans can be tied to being in the top quartile. Bonuses. Your hiring practices may be influenced by what you either want to leverage or improve. Succession plans can be influenced. Strategic or capital investments in new market opportunities or new products or new technologies could be influenced by where you are on your scorecard. And lastly, adopting business practices and strategic planning practices that focus consistently on creating the greatest value for your shareholders and maintaining that useful dialogue between you and the board. So, how does this all come together? I know we covered those quick steps pretty quickly, but we started off by saying, how do we communicate with our boards in terms of discussing performance? And I did the leap of faith of moving it to a value discussion. Well, it's pretty straightforward with this process. Number 1, you end up with a common language and process. You've identified key metrics, you've developed your scorecard, and you have a consistent, repeatable process to implement. Number two, now all of a sudden you've got management and the board on the same page. You've mutually agreed on what drives or what creates value. You've agreed on a process. You've developed a targeted dialogue. It's certainly easy to understand and practice, and hopefully engaging and structured, from a purpose standpoint going forward, purpose being good dialogue and value creation. When we sent out the invitation to this webinar, we had some simple questions we asked if you could answer affirmatively to. We happen to believe you can if you follow this practice. Number one, is your reporting vehicle timely and accurate? Well, that depends. If you use us, it will be, but if you do it yourself, the onus is on you. Does it highlight key performance indicators that drive shareholder value? No question. Does it reflect current and trend data clearly? In terms of the process we use, it gives you a 5-year trend analysis. Does it rank your performance against targeted peers? That's its purpose, and it does it well. Can you summarize everything you want to know in one page? Pretty much. If practice is value likely to be created, well, the proof is in the pudding, and it's at the line of execution, but we can tell you that this methodology is best practice, and the banks that create the highest value use a process either exactly like this or very similar. And then lastly is, does your staff have the time to prepare and present data? Well, certainly that's a question for you to answer, but it's a good segue for me. Before I segue, though, another question I received is, how important is the narrative in report with the scorecard, which might explain, for example, some of the areas they are ranking lower? Narrative is critically important, and part of this process is learning the capabilities and the characteristics of peers that you're benchmarking against, or internally your own performance. Needless to say, to create a narrative around what you're doing well or not doing well is a little easier. When you start looking at others' practices, that becomes a resource issue, but if you can identify those top performers, take a look at their website, look what they do. We certainly encourage a structured narrative around this criteria. I do think that falls somewhat on the shoulders of management. To be honest with you, if you decide you really want to expand on your narrative, we certainly have capabilities that can support you. I'm going to jump to the conclusion here and then come back to a couple of questions that have been passed to me. But this is the segue to us. So does staff have the time to prepare and present the data? If they don't, we have something called the CD scorecard and analysis. What you've been looking at is an example of that. But in short, it's a custom bank performance report. It's designed specifically for management and the board to have these types of discussions. It's produced quarterly. It compares your bank to a custom peer group, and it also includes the UBPR assigned peer group from the regulators. There's over 40 categories, charts, and graphs inside a 28-page report. But something I really want to stress, it has that scorecard, and that's really what drives and facilitates your discussion with your board. So there's my little pitch, ladies and gentlemen. Another question I've received is, what is best practice for training the board to better understand metrics? What impacts them and how to improve them? Great question, and this is something that I tend to look to the CEO and the CFO on. We certainly have chimed in and helped a lot of our bank clients with this, but sitting down and when you introduce this scorecard approach, is taking a look at, and let's just use the 8 criteria that we use, be it return on assets, return on equity, net interest margin, or your spread, or those other conditions. Setting up that initial meeting to break down each one of those with a clear description of A, why are we measuring this particular condition or this indice? Why does it drive value? How does it drive value? And why is it important? Is it, I think, a challenge for both, particularly the CEO and CFO. But it is important in that first meeting to set up a glossary of terms. Funny enough, at least within the peer report we create, it does have a glossary of definitions. I don't think it goes far enough to answer your question, though, because you do need to take time with your board to help them better understand why these metrics are important and how the bank actually influences each one of those metrics.